In exactly 16 days, the United States of America will undergo the largest automatic tax increase in its history. For the last 8 years, you have been living in a financial fantasy, a temporary reality where the government let you keep more of your paycheck, doubled your deductions, and slashed your rates. You got used to it. You built your life around it. You bought your house based on it. But what nobody told you is that this entire system had a self-destruct sequence written into the code. Most of you are celebrating the new year. You're making resolutions. But while you're popping champagne, the IRS is quietly flipping a switch that hasn't been touched since 2017. If you make over $50,000 a year, the sale on your taxes is officially over. On January 1st, your standard deduction, slashed in half. Your tax bracket is jumping up. That $2,000 check you get for your kid, gone. And if you own a small business or a side hustle, the government is about to take a 20% bigger bite out of your profit. This isn't a prediction. This isn't a maybe. This is signed, sealed, and delivered federal law. Today, we are going to break down the 2026 tax cliff. I'm going to show you the exact math of how much you are about to lose, why Congress tricked us into this situation, and the 3 desperate moves you can make in the next 2 weeks to protect your wealth before the ball drops. Because once the calendar hits 2026, it's already too late. Welcome to Financial Stud, where smart money moves meet unstoppable success. Get ready to master your finances and unlock your true earning potential. Section 1. The origin story, the budget trick. To understand why your paycheck is about to shrink, we have to travel back to 2017. The economy was growing, but slowly. The administration at the time wanted to pass a massive tax cut, the Tax Cuts and Jobs Act, or TCJA. It was designed to be the biggest overhaul of the tax code in 30 years. The bill had 2 main parts. Part 1 was for corporations. It slashed their tax rate from 35% to 21%. Part 2 was for you, the individual. It lowered your rates, nearly doubled the standard deduction, and increased the child tax credit. But here is where the trick comes in. In the U.S. Senate, you typically need 60 votes to pass a major law. The Republicans didn't have 60 votes. They only had 51. So, to pass the tax cuts, they had to use a special process called budget reconciliation. Enter the Byrd Rule. Named after Senator Robert Byrd, this rule says that you can pass a bill with a simple majority, 51 votes, but only if that bill does not add to the federal deficit after 10 years. This was the trap. The tax cuts were expensive. They were going to cost the government trillions of dollars. If they made all the tax cuts permanent, the bill would be illegal under the Byrd Rule. It would die in the Senate. So Congress made a choice that is about to hurt you. They decided to make the corporate tax cuts permanent. Amazon, Google, and Apple got to keep their low rates forever. But for you, they put in an expiration date. They wrote a sunset clause into the law. They said, the individual tax cuts will last for exactly 8 years. On December 31st, 2025, they will disappear. They assumed that a future Congress would fix it before the deadline. They assumed no politician would ever let taxes go up. They were wrong. Political gridlock has frozen Washington. And now the timer has hit 0. The sunset isn't in the future anymore. It's next week. Section 2. The breaking point, the 2026 math. Let's stop talking politics. Let's talk about your money. Many of you have forgotten what taxes looked like before 2018. You've gotten used to the TCJA era. Here is the cold, hard math of what happens on January 1st. The standard deduction collapse. The biggest change is the standard deduction. Right now, in 2025, a married couple can earn roughly $29,200 and pay 0 federal income tax. It's a massive shield that protects your money. In 2026, that shield is cut in half. It drops to roughly $14,600, adjusted for inflation. This means an extra $15,000 of your income is suddenly exposed to taxation. Even if you are in the lowest bracket, that is an automatic $1,500 to $2,000 tax hike. Now, the accountants in the comments will say, but wait, the personal exemption is coming back. And that is true. Before 2018, you got a deduction for every person in your house, $4,050 per person back then. That system returns in 2026. But here is the catch. The math still hurts most people. If you are single with no kids, you lose big. The return of the personal exemption doesn't make up for the loss of the massive standard deduction. The bracket shock. Then we have the brackets themselves. Right now we have the 10%, 12%, 22%, 24%, 32%, 35%, and 37% brackets. In 2026, most of those numbers go up. The 12% bracket, it becomes 15%. The 22% bracket, it jumps to 25%. The 24% bracket, it spikes to 28%. The 37% top rate, it goes back to 39.6%. I want you to really process this. If you are a middle manager making $95,000 a year, you are currently in the 22% marginal bracket. On January 1st, you wake up, go to the same job, do the same work, but suddenly the government is taking 25% on that income. That is a 3% pay cut that your boss didn't give you, the IRS did. The child tax credit. And for the parents watching, this is where it gets ugly. Under the TCJA, you got a $2,000 tax credit for every child under 17. And you could get it even if you made up to $400,000 a year. In 2026, two things happen. 1. The credit drops to $1,000 per child. 2. The income limit crashes. Before, you could make $400,000 and get the credit. In 2026, if you make over $110,000, married, the credit starts disappearing. If you are an upper-middle-class family with 2 kids, you are losing $2,000 in credits and likely losing eligibility entirely. That is a $4,000 swing against you. Section 3. The hidden traps, AMT and pass-through. If you think the brackets are bad, wait until you hear about the hidden taxes. These are the ones that don't make the headlines, but they destroy wealth faster than anything else. Trap 1. The AMT, the Alternative Minimum Tax. This is a shadow tax system designed in the 1960s to catch millionaires who weren't paying taxes. But because it wasn't indexed for inflation properly, it started catching the middle class. The 2017 tax cuts basically fixed this by raising the exemption high enough that almost nobody paid it. Guess what? That fix expires. In 2026, the AMT exemption drops significantly. If you live in a high-tax state like New York, California, or New Jersey, and you make between $200,000 and $500,000, welcome to the nightmare. You will likely have to calculate your taxes twice and pay the higher amount. Trap 2. The small business killer. Do you run a side hustle? Are you a freelancer? Do you own an S-Corp or an LLC? Since 2018, you've enjoyed something called Section 199A. It allowed you to deduct 20% of your business profit tax-free. If you made $100,000 in profit, you only paid taxes on $80,000. It was a gift. On January 1st, that deduction vanishes. Your taxable income instantly jumps by 20%. When you combine that with the higher tax brackets, your effective tax rate could skyrocket by 7% to 10% overnight. Section 4. Modern parallels. Why this feels different. We have been here before. In 2012, we faced a fiscal cliff where the Bush tax cuts were set to expire. Back then, Congress panicked and passed a last-minute deal to save most of the cuts. So, why am I worried this time? Because the economy of 2026 is nothing like the economy of 2012. In 2012, our national debt was $16 trillion. Today, it is over $36 trillion. The government is broke. The interest on our debt is now higher than our defense budget. Congress needs your money. They cannot afford to extend these tax cuts. It would cost another $4 trillion over the next decade. The political appetite to save you simply isn't there. The Democrats want the taxes on the rich to go up. The Republicans are fractured on spending. This is the perfect storm. The sunset is likely to happen because inaction is the easiest path for politicians. If they do nothing, taxes go up, revenue goes up, and they can blame the other side. Section 5. The escape plan, 3 moves to make now. Okay, take a breath. The bad news is the law is changing. The good news is that you still have roughly 2 weeks before the books close on 2025. The tax store is closing, but the doors are still open. Here are the 3 specific moves you need to consider right now. Move 1. The Roth conversion sprint. Strategy 1 is the Roth conversion. Think about it logically. Taxes are historically low right now. They are guaranteed to go up in 16 days. Does it make sense to pay taxes on your retirement money now at 22% or 24%? Or wait until you retire and pay 25% or 28%? If you have a traditional IRA or 401k, you can convert some of that money to a Roth IRA this year. Yes, you will pay taxes on that money today. You write a check to the IRS now, but then that money grows tax-free forever. And when you pull it out in 2030, 2040, or 2050, you pay 0 taxes. You are effectively locking in the 2025 tax rates for the rest of your life. If you believe taxes will be higher in the future, and they will be, this is a mathematical no-brainer. Move 2. Tax gain harvesting. Strategy 2 is controversial. It's called tax gain harvesting. Usually, we sell losers to save on taxes. But this year, you might want to do the opposite. If you are in the 15% capital gains bracket now, realize those gains. Sell your winners, pay the tax, and immediately buy them back. Why? Because you reset your cost basis. If you wait until 2026, your income bracket might jump, pushing you into a higher capital gains tier, from 15% to 20%, or subjecting you to the net investment income tax, an extra 3.8% that you might have avoided before. Pay the devil you know today, rather than the devil you don't know tomorrow. Move 3. The timing shift. Strategy 3 is simple timing. If you are a freelancer, get paid now. In December, every dollar you earn in December 2025 is taxed at the lower Trump rates. Every dollar you earn in January 2026 is taxed at the higher rates. Accelerate your income. Invoice your clients today. Conversely, defer your deductions. If you need to buy a new laptop or make a charitable donation, wait until January. Why? Because a $1,000 deduction is worth more when your tax rate is higher. A deduction at 22% saves you $220. A deduction at 25% saves you $250. Buy the laptop in January. Get paid in December. It's simple arbitrage. Conclusion. The new reality. The 2026 tax cliff is a reminder of one fundamental truth. The government changes the rules of the game constantly. In 2017, they gave us a carrot. In 2026, they are bringing out the stick. You cannot control the deficit. You cannot control Congress, but you can control your own dashboard. The difference between the wealthy and the average person isn't just how much they make, it's how much they keep. The wealthy are meeting with their CPAs right now. They are executing these strategies right now. They aren't complaining about the tax hike. They are preparing for it. Don't let January 1st catch you sleeping. You have a window of opportunity. Use it. Now, taxes are just one part of the equation. The other part is where you put that money. Next week, I'm dropping a video on the housing market flip, because while taxes are going up, Zillow just released data showing that housing inventory in 5 specific states is exploding. If you are thinking of buying a home to lower your tax bill, do not sign a contract until you see that video. Like the video, hit the subscribe button, share with your friends, and turn on notifications, and I'll see you in the next one.